Okay, we'll come back. Welcome back.
All right, thanks.
Okay. Yeah, so this is, I think this is where we ended. So for current assets, see, we have cash and bank balances and which is 15,000. Then we also had the debtors. Just confirm what we had. So debtors we had 15,000, then cash we had 2,000. So if the amount was, if the current assets were including the stock, we could have subtracted 10 kwacha, but 10,000, but because it's not part, no wonder we are doing this. So this is what we are supposed to do. So it will be just this plus this, then you divide the current liability. The current liability, that's 9. That's 9. So when we divide 17, divide by 9, what are we getting? Let me just, if you have a calculator there, you can also. Okay, so the answer will be 1.8, we round off. This is the quick ratio from the data that you have been provided. So if we had a figure like current assets amount and stock amount, we could have subtracted stock from current assets, then we divide by liabilities. But the way it is, we are not given the amount for current assets. So we just add the 15 plus 2, then we divide by 9. This is how you can get your quick ratio. The next question is the current ratio. So the current ratio will be calculated as follows. So the current ratio is equal to a current assets over current liabilities. So current assets in this time now, it will be, we need to add 15 plus 2, which was the cash, plus stock. So stock was how much? 10. So plus 10. Then divide by the current liabilities, which is 9. So 15, 17 plus 10, 27. So it will be 27 over 9, which is going to give us, I think, 3. So this is how you can find the current ratio. I hope, I don't know if you are following, is it clear?
Not really. Just go back to the question.
Okay. Yeah, so the question, this is the question, calculate the liquidity ratio. So these are liquidity ratios.
Mhm. Okay, so now these quick ratios, these will not be given, right? So you have to choose, right?
Now they
You
will
have
give
to,
you
you have,
the,
you have to.
so usually they'll give you this information.
Mhm.
Then from the information, that's where now, so the most important thing is to know the formula. We need to know the formula, how to calculate the quick ratio. We need to know the formula of how to calculate
The current ratio.
current ratio. Then from there, you'll be able to.
So meaning, like, for example, on the quick ratio, you just press these to my arrows to search for the correct answer, right?
Yeah, yes, so you need to calculate, then you
Okay.
press, then you
Okay, all
find
right.
the correct answer. Yes.
Okay, so the last question on number 2, where you said plus 10,000 kwacha stock. My question is,
Mhm.
the formula for current ratio is current assets. So stock is an asset, it's a current asset which you will
Yes.
have for a while, isn't it?
Yes, yes. So cash, debtors, stock, all these are current assets. So you add them together, then they make current assets.
A vehicle is a non-current asset.
Vehicle is a non-current asset, yes. So a current asset, it is that asset which has got a lifespan of less than
1 year.
1 year, 12 months. Yeah,
12
so
months. All
those
right, cool.
assets which have got lifespan more than 12 months, they are called non-current assets.
Okay, all right.
Okay. Okay, so let's do the last one. Okay, so just so now we are asked to calculate the cash ratio. So cash ratio is cash is equal to cash and bank. Okay, and bank over current liabilities. So the cash we have from the question is 2,000. So 2,000 over current liabilities, which is 9,000. So we divide 2,000, 9,000, 2,000, you will get 2,000 divided by 9,000. It's something like 0.22. So this is the cash ratio. In case they have asked you to explain, give an explanation what these ratios mean. So what it means, for example, on a quick ratio, it means this is how much cash you have. You have got 1.89 times of cash to meet the current of liabilities or to pay the current liabilities when they fall due. So these are like times. So it's 1.8 times. So like for current ratio, it means you are 3 times capable already to pay the current liabilities that when they fall due. So meaning that from the current assets that you have, you are able to pay even 3 times, which is a good thing. And like here on the cash ratio, where you have a 0 point, meaning that the cash that you have, it's not even able to manage to pay the current liabilities that you have, the 9,000, the 2,000 that you have on top. It's not enough. It's not good enough to pay 9,000. Here, on current assets, the 17,000 is good enough to pay at least 1 times and maybe 89%. Current ratio, you are able to pay the 9,000 even 3 times. So that's what it means. When you go to the next question, okay, so the next question says, are you there?
Yes, very much.
Okay. The next question says, what is prudence or conservatism in the conceptual framework of financial reporting? So these are what we are learning under that topic. The second topic, the conceptual framework.
Sorry, Simon.
Hello.
This one is also being recorded, right?
It's recorded. Yes, I'm recording.
It is, right?
Yes.
Oh, all right. Thanks.
Okay. So what is prudence or conservatism in the conceptual framework of financial reporting? So here, basically, they're just trying to ask you where prudence is falling. Is it a principle? Is it an element? Is it a quantitative characteristic? Is it an underlying assumption? Is it a constraint? So I think the answer here is a principle. So these are prudence, matching concept, all those. They are what we call concepts. I mean, they are all what we call principles in accounting. Okay, so these are theories that we need just to get acquainted with it. So we can go to the next question. Okay, what type of financial statement element is closing stock in the financial statement? In the financial position, financial statement, in the statement of financial position. So I think you had already explained on the closing stock, right? The stock. So stock is the current asset. I think I remember you mentioning that. So stock, cash, debtors, all those, or prepayments, all those are current assets. Is that fine? Is that okay?
Yes, that's fine.
The next question. Question says, the element of financial statements which shows a present obligation of the entity to transfer economic resource as a result of a past event is called. So you are transferring or you are paying. You are transferring the economic resource. The cash that you have, you're transferring it as a result of a past event. So that's kind of a transaction. What is it going to create in your organization? Is it going to create a capital? Is it a capital issue? Is it going to create a gain? Is it going to create a loss? Is that a liability, or is that an asset? Is that a comprehensive income? So this is just a definition of a liability. So a liability is a present obligation of the entity to transfer an economic resource as a result of a past event. This is how we define a liability.
Okay.
Okay, and the opposite is an asset. Here on the asset, it means we are receiving, or that economic resource is creating or is generating revenue for the entity or for the company. So it means that becomes an asset. So if you have an economic resource which is generating revenue for you, that is an asset. If it is getting from you, it is a liability. Okay, then this one, number 5, which of the following is not a qualitative characteristic of financial information? Okay, I'm sure you have read on qualitative characteristics of the financial information, where we learn that the financial statements, information that we are providing to the intended users, it's supposed to be of the quality it deserves, so that the users, as they use this information, they'll be able to make informed decisions. So there are those qualities that the information is supposed to have. Yeah, so qualities such as relevance, this is a qualitative quantity, a qualitative characteristic. Timeliness, yes, this is also a characteristic. Comparability, it is a characteristic. Faithful representation, yes. And not going concern, because going concern, this is now a concept in accounting. So going concept is a concept in accounting which says that when the accountants are preparing, or when the entity is preparing the financial statements, the financial statements should be prepared on the basis of going concern or ongoing concern basis, meaning that there should be that assurance that the entity will be there in the next 12 months or 1 year, more than 1 year or more than 12 months. So the idea is when we prepare financial statements, we should give assurance to the users that the company is going to last more than 12 months. It is still as a future, as the foreseeable future, more than 12 months. But if we prepare accounts, even when we know that things are not okay in this company, then 6 months, 3, 4 months down the line, the company is liquidated, the company has serious problems, the company is liquidated, then we can find ourselves in trouble as a company because we did not give a true picture of the state or the current affairs or the state of the organization. So you're supposed to be truthful in short as we prepare the financial statement. So the going concern, it's a concept in accounting and not a characteristic. Okay, then the next one is the reduce the depreciation account, you credit it. So is it true or false? Yeah, so depreciation is an expense. And I always say that all expenses are debits. All the expenses, they maintain a debit balance. So if you are reducing an expense account, since it maintains a debit balance, then you are supposed to credit. Then you reduce the depreciation account. So in account, any expense, not only depreciation, when you are reducing it, you credit. Supposed to enter a credit on the credit for that balance or that figure that you are reducing the account with. You are supposed to credit it. Then you are reducing at the expense. If you are increasing an expense, you debit, meaning that that expense will accumulate. So this is true, of course. Let's go to the next. I hope you are okay on the expenses. So this is just one of
yes,
the...
I'm okay. So
Hello?
yes, I'm okay.
Okay, so any expense. So they have just given an example of depreciation. So if they will bring, for example, rent expense, the answer should be the same. Electricity, water, whatever it is. When you are reducing, you credit. When you are increasing, you debit.
Okay, so meaning, Simon, because depreciation expense has a debit, so if you have to reduce it, you have to credit.
You have to credit, yes.
So if you have to increase it, it will be a debit like that.
Yes.
So let's say if it's a revenue
or
something bringing money, it has a credit. So if you have to reduce it, you have to debit.
You have to debit, you do the opposite, yes.
Okay. All right, cool, thanks.
Okay. Among other things, the statement of changes in equity will show a cash generated from operations, no. So a statement of changes in equity. So at the end of the year, you prepare the statement of income, comprehensive income, the statement of financial position. Then the other statement you prepare is the statement of changes in equity and the statement of cash flow. So in the statement of changes in equity, you are dealing with only equity items. So the equity items, usually it's capital itself, those reserves, evaluation gains or losses. Those are the things that you usually find in equity. If the capital, if the company issued more shares during the year, you expect changes on the capital, on the balance for the capital. If some shares were diluted or sold, you expect all those changes in the statement of changes in equity. So cash generated from operation, no. So here we don't record any cash. The assets, liabilities, and equity of an entity. So this one cannot be because assets, we don't record any assets there or liabilities there. Of course, we record the equity. So since it's included, see one sentence, C is not correct. D, a picture of financial position of the business at a particular date. So this D, we find it in a statement of financial position, not statement of changes in equity. So D is not correct also. So meaning that B, losses made during the, so losses, yes, these we record them. So I said the reserves, evaluation reserves, which also includes the losses or retained earnings. So these usually we record them because they are part of equity for the business. Okay, the next question is asking us to calculate the ratios based on the following. So we have credit sales 75,000, cost of sales 36,000, trade creditors 9,000, cash and bank balances 2,000, trade debtors 15,000, stock 10,000. Okay, so these are the efficiency ratios they want us to calculate. So how do we calculate these efficiency ratios? So average data collection period in days. Okay. So the formula for average data collection period is as follows. Average this is equal to so you say debtors over credit sales. credit sales, then in times, since they want in days, so we multiply by 365 days in a year. So we go to the question. So we've got credit sales. So we're looking for credit sales and the debtors. So the debtors 15,000, credit sales 75,000. So 15,000 over 75,000. And 365 days. She's going to give us how much? So this is 15 divided by 75 times 365 days. So the answer, the number of days will be 73 days. So meaning that the debtors for the business, they are taking 73 days to pay for the credit sales that we sold to them. So we sold goods to our creditors, to our debtors or customers. Now they are taking 73 days to pay. This is what it means. Then two is asking us what? Average creditor period. Okay. So is that okay?
Yeah, very okay.
Okay. So average creditor period will be average credit period. So in the same vein, so here we say creditors. Okay. So creditors over cost of sales. So if we have purchases or credit purchases, we use credit purchases. If we don't have credit purchases, then we use the cost of sales. So we just have to watch out. But usually nowadays, the way questions are prepared or the way financial statements are prepared, we would not usually we will not see the purchases, credit purchases. They'll just give you the cost of sales. So if you are given the cost of sales, you use it. And 365. Okay, so our credit sales, our creditors, sorry. So creditors 9,000. Then cost of sales 36,000. So you have a 9,000 over 36,000. Times 365 days. Okay, just use my calculator. So 9 divided by 36 times 365 days. So we have 91 point. So these are days, so we don't need to, we need to round off. So it will be just 91 days. So that's the answer there. What's the next question? The period.
Simon, just a quick one.
Yes, yes.
So if it was 91.7, are you going to say 92 days or just say 91 days?
It was 90. 91.
I'm saying if the answer was 9, for example, if it was 91.7, do we say 92 days or we say 91 days?
Yeah, you can round off, so meaning that you have 92 days.
Okay, thanks.
Yeah, so this is how you can calculate the creditor payment period. So not 43, this one was not correct. Then the average stock days. So average stock days in the same vein. Average stock days will be, so the stock or the average stock over the cost of sales times 365 days. So the average stock was how much? So I've got 10,000, the cost of sales at 6. So 10,000 over 36 times 365. So why they call it average stock? In case you are given the opening and closing stock, these figures they are given in the question. You are supposed to add and then divide by 2, then you get the average. But if you are not given the opening, you are just given the closing, then you just use the figure that you are given as closing. So the answer will be okay. So 10 divided by 36 times 365. So the days that we find is 101 days. Yeah, it's 101 days. Okay, so here they are not rounding off, but so it's fine. You cannot have half day, just write in full. So as long as you know what we are doing. Also here they are not rounding off, but it's just okay. So that's how you calculate the average stock days. Okay, is that okay?
Yes, that's okay.
Okay. Then the next question says, what is the profit for the year based on the following balances? Okay, so we have sales 20,000, cost of sales 10,000, closing stock 2,000, expenses 3,500, and cash 18,000. Okay, so to find the profit, we are supposed to use the profit and loss account or the statement of financial position account. Yeah. Okay, so if you go to the statement of income or comprehensive income or the profit and loss, usually you're going to have first of all the sales. Then if you have any purchases, closing stock, you add opening stock to the purchases. Then if there is closing stock, you subtract, then you have the cost of sales. Then you subtract the cost of sales from the sales to get the gross profit. Thereafter, you less any administration expenses. In this case, we have 3,500. Then you have your profit for the year. So we can do it. It's not complicated. So do it in this manner. So profit. So from the information that we have, we start with the sales. So sales. Then we are going to less or subtract the cost of sales. Then here we are going to what the figure we are going to get is what we call gross profit. So gross profit. Okay, so let's start. So the sales from the question. What is the sales amount? Trying to okay, having challenges with the page I'm sharing. Let me.
Okay.
Okay, can you use this one? You're able to see this?
Yes, I can see it.
Okay. Yeah, so our sales were 20,000, cost of sales 10,000, and the expenses 3,500. So we go back to the, so say 20,000. The cost of sales 10,000. So we subtract. So when we subtract, we are going to have 10,000 as our gross profit. So this is just a gross profit, but the question is asking for profit for the year. So now we less the expenses. Which is the 3,500. So when we less that from that, I'm sure we'll get 6,500. So this is what is, this is our profit. profit for the year. Yeah, so this is how we find the profit for the year. So it is in sales less cost of sales, you have gross profit, then you less any other administrative expenses that you are given, then you have your profit. So this is the format for the statement of comprehensive income. It's very straightforward, it's very simple as it is. Except like when you
Yes, simple.
Simple.
Yes.
Yeah, so when you talk of expenses, you are going to have several expenses here. Electricity, rentals, all those administrative expenses. Then here on the cost of sales, this is where you just need to make adjustment. You have the opening stock, the closing stock, and the purchases. So how to get to the cost of sales? First, you start with the opening stock. You add the purchases, then you subtract the closing stock. Then you have your cost of sales. So usually these are the adjustments that you do. You have to work out on the cost of sales. Then on the sales, sometimes you have those returns inwards. So if you have returns inward, you just make adjustment. Then on purchases also, you have returns outward, you make adjustment. Then sometimes you have carriage inwards, you make those adjustments, or carriage outwards. So the other question says what? Okay. So it's C and positive. This is a profit. Okay. Okay, we have the next question, number 10. Which of the following is not a purpose of accounting? Okay. We can start with the one which are not ticked to enable the users to ascertain whether the entity is owned by the other entities or parties. So this is not true, because this is one of the purposes of accounting. We prepare accounts so that the users can know what we are owing, what the company is owing other parties, to enable the users to ascertain what the entity owes at a particular time. So this is also our duty. This is also the purpose of accounting. You prepare so that you know at any particular time what you own as a company. Then D, to enable the users to ascertain how the entity performed over a specific or given period. So it is also the purpose of accounting. We need to know the performance. Are we making profit? Are we making losses? Then C, to enable the users to ascertain how the entity is financed. Yes, so this is also a purpose of accounting. We need to know how the entity is financed. Is it financed by equity, or is it financed by debt, the loans? So when we look at the face of the financial statement, we'll be able to know whether the company is either financed by equity or debt. Then enable the users to ascertain the entity, what the entity owes other parties. Yeah, so this is also a purpose. We want to understand, the users who want to know what we owe as the entity to other parties. So meaning that which is it to provide information to non-financial users of financial information to enable them to make decisions. Yeah, so meaning that this is not true. We provide whatever we do, we are doing it for the users, not for non-financial users. So this one is also straightforward. A true or false question, a partnership agreement can be written or unwritten. So the answer is true. It is true. A partnership has got no strict rules like a company or a limited company. The partnership is just like a sole trader where there are no strict rules. So it's true that it can be written or not written. So we find that for those who are very formal, the partners who are very formal, they will have a written contract or written agreement between the partners. The others who are not very formal, they can even just by word of mouth, they can just agree to say, let's do this, let's do this. They start doing that, the business. So that is very true, but not a company, not a limited company. A company, there is a, remember, it is formed, a company is formed under the Company Act. So those laws are supposed to be followed even as we manage the company. Unlike the partnership and sole trader type of businesses. Number 12, which financial statement represents the accounting equation? Okay, so the accounting equation can only be represented by the statement of financial position or the balance sheet. Not the cash flow, not the statement of changes in equity, not the comprehensive income. Comprehensive income, we're just showing the profits there, the performance. Changes in equity, we want to know the changes in equity. What has changed in share capital? Is there any losses that we made during do we have any accumulated losses or gains from the previous years? The cash flow will just show you the cash items in terms of payments and receipts. So the correct answer, of course, is D, which is the statement of financial position. So the financial position will show you, it is an equation because it will tell you that as total assets are equal to total liabilities, or total equity and the liabilities, total equity and the liabilities. They are supposed to equal. Then you have a statement of financial position or a balance sheet. Interest cover ratio is the gearing ratio, true or false? So interest cover ratio is the gearing ratio. The answer is supposed to be true. I don't know why they picked false. So the answer is supposed to be true. So the interest that we pay it as a result of the gearing that we have entered into, because gearing talks about the debt that we contract, or that the money that we borrow to manage or to generate revenue for the company, or to capitalize the company operations. So the interest that we pay, it's part of gearing. So the interest cover ratio, it's where we want to know how much, how comfortable, how capable we are as a company to pay the interest when they fall due in a particular time, on a particular year. Are we able to pay? How many times? This one is also measured in times. So if you saw, meaning that you have to divide the interest into the profit for the year that you have made. So when you divide interest into the profit, you are going to have, for example, 2 times, 3 times, 4 times. So meaning that you'll be very comfortable as a company to say, okay, we are able to pay the interest obligation that we have to the lenders. So it is supposed to be true and not false. I hope it is clear, Mr. Raphael there.
Very clear.
Okay. Then cash inflow in a cash flow statement includes. Okay, so just from the word cash inflow, there is cash outflow and cash inflow. So the cash flow statement will have 2 headings: the cash, the receipts and the payments, or the cash receipts and the cash payments. So since here they are talking about the cash inflow, meaning that we are just looking at the receipts or the cash that is coming in. So of course the answer should be A, the receipts from the data. So one examples of the cash receipts that we can have on the cash flow statement is receipts from the data. We can have other type of cash that we will receive during the period. So as we are doing the cash flow, any cash receipts that we had in the period are called cash inflows. So for example, we can have cash sales. We sell on cash. Maybe we sold an asset by cash. So that amount is supposed to fall under cash receipts. And not, these payments are now called cash outflows. So these are cash outflows. So payments to acquire plant and machinery, this is a cash outflow. Dividends paid, money is going out of the entity. So this is also a cash outflow. Interest paid is also a cash outflow. But if it was interest received, it was going to be a cash inflow. If it was the dividends received, it was going to be cash inflow. But paid, all these are cash outflows. Profit for the year reported in the statement of comprehensive income is taken to the statement of financial position and shown as part of. So the profit that we make at the end of the year, we report it, which is reported in the comprehensive income, is taken to the financial position and shown as part of. We've got equity, yes, supposed to be shown as part of equity. I think I've already mentioned on this one. So equity, what forms equity is the share capital, profit for the year or retained profits, then revaluation reserves, all those. Premium share capital, preference share capital, all those, they form equity. So the profit that we make in in the year is supposed to fall under the equity and not current assets, not evaluation reserves, not liabilities, but under equity. The umbrella is equity. These liabilities and the valuation reserves, they are also where they are falling. They are also falling under equity. So it's equity, which is the umbrella. Okay, then we go to the next question. A customer who had been sold goods on credit returned goods worth 100,000. The correct accounting entry to record the returned goods is debit sales returns account and credit customer account. Okay, so the answer is 2, yes. So when a customer returns goods, the two accounts or the two ledgers that are affected that we are supposed to open is one, the sales return, and two, the customer account or the credit customer account. So initially we sold the goods to this customer and the customer has a debit balance or a debtor has a debit balance. So if the customer brings back or returns the goods that we sold to him, our customer balance, for example, it is 100, it is 200,000, and then he has returned 100,000. We are supposed to adjust that balance because he has returned the goods. So meaning that what he is owing us is no longer 200,000. It is supposed to be reduced by the returns. So meaning that the customer who is a debit, to reduce or to adjust the balance, the customer balance, we are supposed to credit. We credit the customer and we debit the returns account that we have opened. So this is just the double entry, purely double entry. If we understand the double entry, the golden rule in accounting, this is very easy and straightforward. So the double entry system and the golden rule says debit the receiver, credit the giver. It is one way also that you can use to memorize or to understand the double entry system. So you debit the receiver, credit the giver. So the account that is receiving, you debit it. The account that is giving, you credit.
Okay. Yeah.
Okay, the next question is, where is the statement of financial position? Where in the statement of financial position is the accumulated depreciation disclosed? Okay, so the question is about the treatment of accumulated depreciation. So the answer is netted off against the cost of utilizated non-current asset and not loss, not accumulated reserves or non-current liability. So how we treat accumulated depreciation, we net it off against the non-current assets. For example, we have a motor vehicle which is being depreciated every year. We have a motor vehicle at a cost of 100,000, and every year we are depreciating it by 10,000. So for 3 years, the accumulated depreciation is going to be 30,000. So every year, as we prepare the financial statements, in the statement of financial position, the motor vehicle amount is going to be adjusted. So first of all, we show the cost, which is 100,000. So for after 3 years, the depreciation has been 30,000. So you subtract 30,000 from 100,000. So you have 70,000. So in that current year, again, you depreciate, you charge depreciation. So meaning that from the 70,000, again, you subtract 10,000 and you remain with 60,000. So that 60,000 will be now the net book value for the motor vehicles, which have been depreciating. So every year you'll be accumulating. So in the coming year again, accumulated depreciation will start now at 60,000, at 40,000, meaning that 30,000 plus the 10,000 last year, total you're going to have 40,000. So you subtract 40,000 from 100,000, you remain with 60,000, and then you charge depreciation in that current year. So when you charge 10,000 from 60,000, you have 50,000. So every year it will be just going on like that. So we don't show it per se, but we net off against the costs of the related current asset. So usually in the financial position, we just show the net assets. The current format that most of the companies use today, they don't show accumulated depreciation. You just do it as a working. You just calculate it as a working somewhere. But in the statement of financial position, you will show the net book value. So here that's what is done. So it is netted off against the cost of the related non-current asset. Is that okay?
Yes, it's okay.
Okay. Then number 18, the accounting equation can be written as liability is equal to assets plus capital. So this is not true, this is false. So the accounting equation is assets equal to capital plus liabilities. And not liabilities is equal to capital plus asset. Okay, so this one is all straightforward. Go to 19. An increase in the average days a company takes to pay its creditors could be good or bad. So it's a question. An increase in the average days the company takes to pay to its creditor could be good or bad. So is it good or bad? Mr. Raphael, is it good or bad if we take there's an increase in the average days that we are taking to pay our creditors? Is it good or bad for the business? What do you think?
It's bad because the longer we take, the more interest we pay. So
Okay.
it's
Now,
bad.
just in case they were not paying any interest, is it good or bad?
An increase in the average days a company takes to pay its creditors.
There is no interest that we are paying. It's just that amount, that principal amount.
No, it can be good then, because now we'll be using our money to make money.
Yes.
Then we can pay them later when you make profit on whatever we're selling.
Yes, that's the idea. So it is a good thing when there is an increment in when the days of paying, the credit period has been extended. So it will be an advantage to the business. That's what it means there. So you can even say you can also say that the the extended credit period will improve our cash flow as a business, because the money that we are supposed to pay the creditor, we can use it to reinvest or to buy more stock and make profit, as you say. Okay, number 20. What type of financial statement element is an end revenue? So the revenue that we have not yet earned, is it a provision? No. Is it a liability? Is it an expense? Is it a loss? So it's a liability. We have not earned the revenue. So there's nothing that we can claim because we have not earned anything. No wonder it's better we pick the liability. You cannot recognize the revenue that we have not earned. The accounting, in accounting, it does not work like that. So we only recognize the revenue that we have earned. An earned revenue is not recognized in financial statements. It cannot be an expense, it cannot be a loss, it cannot be a provision. Maybe it can just be called a liability. Okay. Then number 21, a company paid for telephone expenses amounting to 10,000 by cash. What are the correct entries to record this transaction? Okay, so every transaction affects two aspects, has got two aspects. So when you are opening the ledgers that are affected by that account, you need to have in mind that it is affecting, it has two aspects, the debit aspect and the credit aspect. So when a company pays telephone expense, so first of all, you are supposed to identify the two ledgers or the two accounts that are affected by that transaction. So from this transaction, we are supposed to identify the two accounts, the one which is receiving and the one which is giving out. Okay. So already there, paid telephone expense, that is, the telephone is an expense. So you are supposed to pay the telephone expense account. What other ledger, what other account is affected? It's the cash. So we are paying by cash. So cash and the telephone expenses. These are the two ledgers that we are supposed to open. So the telephone expenses are debits. You debit the 10,000 in the telephone account. Cash is giving out. You credit the cash account. So always the golden rule: debit the receiver, credit the giver. Yeah. So debit the telephone account, which is DBC, debit the telephone account, expense account, and the credit the cash account. And to determine whether to use a debit or a credit to record an increase or decrease in an account, does not depend on the type of the element. Determining whether to use a debit or credit to record an increase or decrease in an account does not depend on the type of element. In case it's false, it has to depend on the transaction. So this one is also straightforward. So it has to depend on the transaction or the element. (23) What are the accounting entries to record a transaction whereby Musonda started a business and transferred his motor vehicle worth 150 into the business? Okay. So what entries are we supposed to make? So as usual, you need to identify the two accounts or two ledgers that are affected by a transaction. So this is Mr. Musonda who has started a business and he has transferred his personal vehicle worth 150 into the business. So this is the capital for the business to start with. And this capital, what type of capital is it? Is it cash? Is it a motor vehicle? Is it an equipment? So it is a motor vehicle. So meaning that motor vehicle and capital accounts are affected, are supposed to be opened. So as usual, a motor vehicle is an asset which maintains a debit balance. So you debit the motor vehicle account and you credit the capital. So B is the correct answer. Which user group is mainly interested in information on the welfare of the employees in a company? Okay, so this one is a general knowledge or general question, straightforward question. So of course it can't be suppliers. Suppliers, they are interested in their money, the money that we are owing them. They are interested in to see whether we have the capacity to pay them, whether we have got the liquidity. The liquidity is okay for the company, the cash position to pay the suppliers. The local communities, so these, they will be interested in things like maybe employment. Are we employing the community? Are we interested in employing the community? How much are we paying back to the community in terms of social responsibility? So the employment opportunities, social responsibility, all those are the things that the local community will be interested in. The environment, are we keeping the well of the environment? Those are the things interested by the local. Then shareholders, the shareholders. So the shareholders, they're also interested in the profitability of the business. Is the business making profit, generating profit from what we have invested, from the investment that we have put in the business? Are we able to see profits being generated? So meaning that the trade union now, they are interested in the welfare of the employees, of course, because these employees, they even make contributions to these trade unions so that the trade unions are able to negotiate good salaries, good conditions of services for the workers, good working environment. 25, an amount of 50,000 due from a customer was deemed to be incoverable The correct entries for this is to debit the customer account with 50,000 and credit the bad debt account with 50,000. So this is not true. So when a customer fails to pay, we declare him a bad debt. We declare a bad debt, so meaning that we are creating an expense. So a bad debt is an expense. So an expense is always supposed to have a debit. So you cannot credit the bad debt. The bad debt expense is supposed to be debited. Then that customer who was owing the 50,000 is no longer going to pay. So why should we keep him? So a customer, usually they maintain a debit balance. So if you want to write off the balance of 50,000, you credit. And not
Credit the
debit.
bad debts, yeah.
It's clear? Is it okay?
Very clear.
Okay. Which of the following statement is not true about sole trader? A sole trader do not need a partnership agreement. Which one of the following is not true? So one is A is true. A sole trader do not have employees. Which one is not true? So this is also true. A sole trader do not need to prepare accounts. It's true. What is not true? A sole trader entity is owned by more than one. More than one. So this is not true. Sole trader is owned by one person and not more than one owner. It's just one person. So this one is also straightforward. To increase a liability account, you need to increase a liability account, you debit it. So it is not true, it is false. So when you are increasing a liability is a credit. So when you are increasing a credit, you will credit and not debit. If you debit, you are reducing. What principle states that a company should record expenses incurred to generate revenue? Okay, so the principle that states that the company should record expenses incurred to generate revenue is a matching concept or principle. So a matching principle states that we are supposed to match the revenue generated with the costs or the expenses that we have incurred to generate that revenue. So there should be that matching. You cannot just generate revenue from without. You are supposed to, you need to expend. You are supposed to spend to generate revenue. So all that expenditure that you incur to make money, it is supposed to be matching, to match with it, the revenue that you have generated. So that's the meaning of the concept. For example, if you are doing a business of any business, you have employees, you are paying employees who are working for you to make the profit or to generate the revenue. So that is a cost that you are supposed to match with the revenue. You are paying electricity, you are paying water, and the other expenses, all those expenses, they're supposed to be matched with the revenue that you are making. Uh, 29. An example of a non-current liability account is so share premium capital. So this is not a liability, but this is not a non-current liability, but equity. A loan account, yes, a loan account is supposed to be a non-current liability. So debenture, loans, all these are non-current liability, not assets. Assets are assets and not liabilities. Cash account, no. Okay, so this one is also straightforward. Closing stock are reflected in the statement of comprehensive income as a debit in the trading account. So closing stock are reflected in the statement of comprehensive income as a debit in the trading account. So the trading account, okay. So this is supposed to be no. Because in a trading account, you have the, that's why you like you do that's where you calculate, that's in the trading account, that's where you calculate the cost of sales. So the closing stock reduces the cost of sales. So there's no way it can be a debit. It's supposed to be a credit. So I wonder the answer is false. So what are debits in the trading account? So in the trading account, you have the opening stock. So opening stock plus purchases. Then you have goods available for sale, which are on the debit. But if you have, when you want to calculate the cost of sales, usually you subtract now the closing stock. So less closing stock, then you have the cost of sales. So meaning that these which are already on the debit, to reduce them, you're supposed to credit. So the closing stock is supposed to be credited. No wonder the answer is false and not debited. Is that okay?
No, this one I've not understood, Simon.
You understand?
No, I don't understand this one.
You don't understand? Okay. So let me demonstrate. So this is a trading account. So it has also a debit and a credit. So a trading account, you have, you start with the opening. So the opening stock, you debit. You have purchases. Remember, purchases, they maintain a debit balance, not? And the stock also maintains a debit balance.
Debit balance because it's an expense. You're purchasing something, right?
And it is receiving. It is more or less like you are creating that account. So it is receiving. So no wonder it's debited. Okay. And then, so meaning that for the closing stock, you are not going to put it, because if you put a closing stock this side, it means you are increasing the amount of cost of sales, but you have not sold the stock which is remaining for the next period. So why should you add it to the as a cost as to the cost of sales? So here you are just interested in what was the opening stock and the additional purchases that you have made. Then when you subtract the closing stock, which is going to be sold in the coming period, then you have the cost of sales. If you include it, then the cost of sales that you are going to have, it's not giving a true picture. So no wonder the closing stock you credit. So you subtract, in short. So the closing stock you subtract, so you'll be enter it on the credit. Then here you have the totals and the balance. So that balancing figure, it is going to be the cost of sales. Okay, let me just say cost of sales. So this will be the cost of sales for the two sides to balance. What you have here will be the the cost of sales, which is going to come here, which you bring here now to subtract from the sales. So you can either calculate the cost of sales using a T ledger, or just the way we do it when we are preparing the profit, the comprehensive income statement, where we just say, if you want to calculate the cost of sales, you will say, first you start with the sales. So sales, as it is there, you have a figure there. Then you say, cost of sales. So the cost or the cost of sales. So under the cost of sales, you are going to have, first of all, you start with the opening stock. So the opening stock, you have the opening stock here. Then you have your purchases. The purchases that you have made, you have added them to the opening stock. So the purchases, you add them. So when you have, so these will be called goods sold. These are what we call goods sold. Then you less the cost of the closing stock. You less the cost closing stock. So you less the closing stock. To have, for you to have now the cost of sales. Cost of sales. Then you bring it here. So that's why now you subtract the cost of sales from the sales to have your gross profit. So we are removing the closing stock. So that's why even here we are crediting. If we put it on the debit, then we are increasing. So we have to put it on the credit. So what you are doing here is the same as so it's either you can use a T account or you can just use it, do it direct here, the way we have done it. I hope you are, I hope you are following now.
No, I've gotten it.
Yes, yes.
Yes, I've got it.
Okay. Yeah, so that's what it means. So closing stock are reflected in the statement of comprehensive income as a debit. No, so it's not a debit, but a credit. If you are reflecting it in the trading account, you're supposed to credit and not debit. Okay, number 31, the process of making entries in the books of accounts, reconciling the accounts and preparing the reports from the books of accounts is normally referred to as. Okay, so this is financial accounting. So financial accounting is a process of making entries in the books of accounts, reconciling the accounts, preparing the reports. So it's a process from making those entries in the prime entry books, the ledgers. You make reconciliations, then you prepare the reports, which are financial statements. So when you are preparing financial statements, it's just the part of financial accounting. Generalizing it is just part of financial accounting. Posting it is also part of financial accounting. Bookkeeping is also part of financial accounting. So all these, they are stages in financial accounting. No wonder financial accounting qualifies to be the answer for this question. One of the basic assumptions which underlie the preparation of financial accounts of a business enterprise is cost, benefit, materiality, cost, full disclosure, and economic entity. One of the basic assumptions which underlie the preparation of financial accounts of the business enterprise is cost, benefit, materiality.
Yeah, it's economic entity.
Economic entity, yes.
It is, yes.
Okay. So this is the assumption which underlie preparation of the economic entity, preparation of the business. Okay, we move number 33, a qualitative characteristics of a financial information that requires that the financial information must be free from material error and bias is called.
Yeah, reliability. Yeah,
supposed to be reliable.
this one,
Information is supposed to be
this one,
reliable.
this is easier.
So the relevance, relevance meaning that the information should be relevant to what we are looking for as a user. Variability, we should be able to verify the facts, the information given. Then materiality, it's supposed to be material enough and not immaterial. And then reliable, we are saying it has to be very true, very straight, material, very free from error and bias. Okay, then 34, profitability ratio exclude. Yeah, so of course, this one we have already discussed it. So interest cover, it's part of gearing ratios and not profitability ratios. So profitability ratios include the operating profit margin, yes. Net profit margin, yes. Gross profit margin. So these are profitability ratios. And not interest cover. Interest cover, it's a gearing ratio.
How much is the
How
insurance
much
cover?
is the insurance? That was prepaid as at the 1st December. If a company paid for insurance on 1st January 2020, amounting to 60,000 for 9 months to 30 September. Okay. So how do we, so they're talking about a prepayment. You know what a prepayment is?
Pay in advance.
Yes, a payment that we make in advance. So this amount was paid when? So as at 1st December, so meaning that as at 1st December, that's when the accounts are being prepared. But the money was paid in January. So from January to December, for 9 months, it was paid for 9 months up to 31st September, 30th September. So when we are in December, meaning that it has expired, not so. It has been, we have used the service, we have enjoyed the service. Because if it was paid up to 31st September, then it means from October to December, we are supposed to make another payment. Yeah, so no wonder the answer is nil. I hope you understand the principle.
Yes, I do.
So we paid up to September and we are preparing the financial statements as at 31st December. So if we didn't make any payment from October to December, then we cannot say we had paid in advance. The money that we paid was just up to September. So from October to December, there's nothing that we paid. So it's no longer a prepayment, but in terms of a prepayment, it's new. Actually, then it means we are even owing. It means now it becomes a owing or an accrual. Which of the following is used to record transaction before posting in the accounts? Okay, so before we post any transactions in the account or in the ledgers, first we start with the journal, the general journal. So we post in the general journal, generalize. After generalizing, then from there we post to the ledger. From the ledger, we post to the trial balance. From the trial balance, now we can prepare the statement of the financial statements. We can prepare the statement of comprehensive income. We can prepare the, and then we can prepare the statement of financial position. So that's how transaction are prepared from the journal, which are called the prime entry books, to the ledgers, to the trial balance, then to the statement of financial, to the financial statements. When should an entity recognize revenue in the financial statement? Okay, so you can only recognize revenue when revenue is earned. Revenue which is not earned, we cannot recognize it as revenue. So accrual basis in accounting, we only recognize revenue that has been earned. Then for accrual basis, there's a cash basis and accrual basis. Like government entities, government in general, they use cash basis. At the moment, government is using a cash basis accounting method where we recognize revenue, recognize expenses once their cash has been paid or cash has been received. That's when you recognize those transactions. For when you are using accruals basis, we only recognize when the expense has been incurred or when the cash has been earned. What is the correct accounting entry for cash discount of 5,000 received by a company from a supplier? So we have received the cash discount from a supplier. So which two accounts are affected? The supplier account or the accounts payable. And the
no, this one is straightforward. Yeah.
It is straightforward. So the accounts payable and the credit cash discount. So we debit the payable because the payable they are giving out. Then the credit cash discount is in. So we create the cash discount and then we debit so that okay, so we are buying on so this is the one way of promoting quick sales by the suppliers. So they'll give you a cash discount if you maybe you buy in bulk and so on and so forth. So this is an incentive that they give. So it's clear this one, right? The 39 says the typical period end adjustments exclude processing cash transactions. Okay, so this should be the answer. Let's check number B. B says an end incomes. So an end incomes, usually we process them or we adjust them. Correction of errors, yeah, we correct errors. Then a bad debts provision, we do that. Prepayments, we also adjust prepayments. We don't deal with cash transactions. We don't process cash transactions. So I think A is correct. So it excludes the processing of cash transactions. Okay. Number 40, to increase the share capital account, you debit it, true or false. So you are increasing the capital account. Do you need to debit? The capital account is a credit balance. So if you want to increase the credit balance, you're supposed to credit. So if you debit, then you are reducing. So no wonder the answer is
Yes.
false. Leverage ratios do not measure the capital structure of the business. So this is false. So leverage, it's the same as gearing. Leverage or gearing, they are the same. So these are the ratios which are to do something to do with capital structure. So the answer cannot be true but false. Leverage ratios, they are the same as gearing ratios. The debt, equity, how the company is financed. Is it financed by debt? Is it financed by equity? So that's about leverage ratios. So of course, they measure the capital structure of a business. Okay, is that okay?
Yes, very okay.
Okay. Which of the following are the internal users of the accounting information?
Employees, this one is
They are employees. So employees are internal users. Shareholders are external users. External auditors also external. Journalists, they are also external users. The element of financial statements which shows amounts put into the business by the owner is called. Okay, so this is also straightforward. Then share capital. So the amount that we put in the business to start the business, to capitalize the business, it's called share capital. Of the objectives of cash flow statement, one of the objectives of the cash flow statement is to show the changes in the cash one of the objectives of the cash flow statement is to show the changes in the amount of cash available to pay dividends, to provide information that assists in the assessment of the equity's liquidity, solvency, and financial adaptability to show the assets. No, don't deal with assets. To show the assets, liabilities, no. Debt of the business, of the entity, no. To show the profit reported in the period, no. Okay, so the closest correct answers is A and B. To show the changes in the amount of cash available to pay dividends. So this one, to provide information that assists in assessing the entity liquidity, solvency, and the financial adaptability. I think the reason why we have to pick B because it is inclusive, which is encompassing all the reasons why we prepare cash flow statement. So it's not just about paying dividends. There are a lot of payments that we are supposed to make, important payments apart from dividends. In fact, dividends, usually it's the last option for the business to pay. It's the last thing that we need to put on the consideration depending on the performance. So first of all, we have to look at the other important. Remember, dividends we are paying the owners, so the owners can wait. If the business has not done well, the owners sometimes they can even forfeit dividends. They cannot be paid the dividend. So the most important thing is we are looking at the liquidity. Is the company in a better position to meet the obligations to pay the current liabilities, the solvency, and the financial stability? So dividends cannot be the best objective or cannot be the main objective, but first of all, we are looking at the liquidity and the solvency. The ability of the company has to meet the obligations. What is the correct entry to record a cash receipt from a debtor amounting to 20,000 that was originally accounted for by debiting debtors and crediting cash? Debiting debtors and crediting cash. So as usual, this is a double entry. If the error was made, how do we make a correction? So the correct entry to record cash receipt from a debtor amounting to 20,000. So the correct entry. So it was initially we debited the debtors and credited cash. So this debtor is paying us, sign. So since they are paying, our cash account is supposed to debit, and the debtors, they are supposed to be debited. We are supposed to reduce what they are owing. So how do we correct since we made this mistake? If we debit 20 and credit 20, it is just going to be at zero. Yeah, but there's a gain of 20. So for us to make a proper entry, we're supposed to double it. So we're going to debit cash by 40 and credit debtors by 40. So the first 20 is bringing the effect to zero. Then the 20 making the correct entry. So that's how we can make that correction. Okay, 46, liquidity or short-term solvency ratios measure the extent to which the company has and has enough asset on its statement of financial position to service its current obligation. Yeah, so that's it true. So liquidity or short-term solvency ratios measure the extent to which the company has enough assets to meet or to meet the obligation, the current obligation. Remember those ratios we are calculating, the current ratio, the quick ratio, and the
Yes.
yes. So those are solvent or liquidity ratios. Okay, so this is the last question. Was the last question.
Mhm.
Yeah, so usually these examiners, they bring, if not the same question, but similar question, same concept, same principles. So the most important thing is to understand these principles, these ideas in accounting. These are the assumptions.
So like, what else can I cover?
Hello?
What else do I need to look out for? Do I need to, because they'll bring about 40, right?
Yes.
About 50 questions, right? Is it 50 or 40 questions?
Somewhere there.
Okay.
So meaning that from what I've seen, what we have covered, so the ratios, you will need to do some revision on the ratios.
Okay.
I think also preparation of the comprehensive income statement, financial position. You look at those pro formas, how we are supposed to prepare the statement of income, comprehensive income, and as well as the financial position. Then you also look at the statement of changes in equity,
Okay.
elements that are found on that state on these important financial statements. Even the cash flow statements, you need to just familiarize yourself with the elements, because I've seen those my questions, that's where they are coming from. It's not like a full question where they are asking you, can you prepare profit and loss or comprehensive income, but they're just trying to, the examiner is just trying to see your understanding of the statement of cash, the statement cash flow, the statement of income, comprehensive income, the statement of financial position, to see just to see whether you understand the elements or how you are supposed to prepare these financial statements.
Oh, okay.
And of course, those theories, principles, the concept,
Okay. So,
types of entities, types of the companies, the advantages, the advantages of a particular type of a business, those you just need to just go through and prepare.
so like, so this is what came last year?
This is what came last year, yes. So
I don't think I have any other questions. I don't think I have any other questions.
Yeah, what you can do, we can still, maybe tomorrow, if you are going to make it, you can even look at that question bank, so that we just go for those multiple choice type of questions. Just go through those questions also, just in case.
Okay.
Even those other theory type of questions, you can look at one or two.
Oh,
At least
okay.
we
Tomorrow
can
you
find,
post
if
the
we can
time.
find another test like this one, no? It can also be okay to just go through another one so that you are confident and you are also ready. At least would have the idea. You have the idea of what is likely to be in the
Okay.
test.
Okay, no, it's very clear. So tomorrow you post the time we're meeting, right?
Yes, yes. Tomorrow, you can. I think tomorrow you can even start at 7, even 15 hours. It's only like the students during the weekend. It's like they are quite committed. But I'm sure since you are writing on a Monday, tomorrow people will be very willing to revise. Yeah.
Okay.
Yeah. So just post
Okay.
in good time, maybe in the morning, so that people are to make adjustments to their programs. So are you going to send the payment now, or
So the you share, you send me something or not?
hello?
Yes, actually, I'm trying to send now. No, I'm trying to send it right now, actually.
Okay, all right, I appreciate it.
Though it didn't give me your name. Hello?
Simon
Hello? Hello?
Funda.
No, it wasn't bringing. Give me your name. Give me your number. 09.
Okay, let me give you are you using Airtel or MTN?
Airtel.
Okay, 0977
Hmm?
40
Hmm?
16
Hmm?
69 401669.
Okay, Simon Funda.
Yes.
Okay, it has come up. Okay. So,
Okay, I've seen a message I've received.
80 kwacha, right? The session.
Yes.
Yeah, now I've sent.
All right.
So thank you so much. We'll catch up tomorrow then.
All right, boss.
All right, no, thanks a lot. Good night.
Okay, good night.